what is driving this selling, other than the fact that the markets are overpriced, is the realization that interest rates are going to rise more than investors had anticipated. In fact, if you look at a lot of these big Wall Street firms, they are ratcheting up the expected number of rate hikes for 2022. In fact, the highest estimates I've now seen for rate hikes is 10. And that may sound like a big number. Oh my God, the Fed is going to hike rates 10 times in 2022. That's how serious they are about fighting inflation. These guys are really on the job. They are inflation fighters. They're going to go medieval on inflation. We're going to get 10 rate hikes, and that is scaring the markets. And in fact, if you look at the yield curve is actually flattening because investors are actually starting to price in the recession that this hawkish Fed is going to cause by jacking up interest rates so much with these 10 rate hikes, because the 10-year bond yield is factoring in a drop in rates that will follow all these hikes, because all these hikes are going to cause a recession, and that's going to result in the Fed reversing course and lowering rates. Now, here is the reality. And again, this has barely begun to set in on Wall Street. I mean, when more and more traders grasp this reality, there's a lot more downside in stocks. But more importantly, if the Fed acts to stop the carnage on Wall Street, there is way more downside in the US dollar, way more upside in gold, and of course bonds are going to get destroyed even if the nominal price doesn't fall because of Fed buying bonds. The real price will collapse much further, but 10 rate hikes is nothing. Assuming all 10 of these hikes are quarter point hikes, after 10 of them, rates are at 2.5%. Big deal. Inflation is 7.5%. And of course, it's actually 15%. But let's just use the government's numbers. As phony as they are, we don't have to use the real inflation rate of 15% to prove this point. We can accept the government's distorted version of reality and just say it's 7.5%. Well, even if the Fed raises rates to 2.5%, you've got 5% negative real interest rates. You're not going to fight inflation with 5% negative rates. There is no history that shows this. I mean, it's impossible. It contradicts any type of economic school of thought that you want to put forth. And in fact, if the Federal Reserve raises interest rates 10 times and each one of those hikes is 25 basis points, by the time they get to 2.5%, real yields will be a lot lower than -5, because by the time the Fed gets rates to 2.5%, the CPI will be at least 10%, maybe more. So the Fed will actually be further behind the curve when it gets to 2.5% than it is right now at 0. It's because moving so slowly allows inflation to accelerate, because the entire time the Fed is hiking rates, it is still pursuing an expansionary monetary policy. But the real risk that the markets still don't get is, even if 10 rate hikes push the US economy into recession, and they probably will, I think the market is getting that right, that's not going to bring down long-term interest rates. Because the reason that people think the Fed will be able to fight inflation with these small rate hikes is because they realize correctly that even small rate hikes are too large for the economy to bear, because we have so much debt. So what the bond market is counting on is the recession doing the job for the Fed, meaning that the Fed won't fight inflation with tight money, but simply making money less loose will be enough to tip the economy into recession, and the recession will fight inflation. Because the conventional wisdom is, if we have a recession, that is going to reduce demand, and that is going to bring down the rate of inflation. So that's what the markets are counting on. It's not the Fed that's going to fight inflation, it's going to be the recession. But the Fed is going to cause the recession with these rate hikes. And that's what they're all referring to as a policy mistake, because they're saying, hey, the Fed is going to hike too much and cause a recession. The recession is not the mistake. The recession is the cure for the mistake. The mistakes were made a long time ago. The Fed continues to make mistakes in raising rates too slowly, not because faster rate hikes will cause a recession, but because they're trying to delay the recession, because the recession is the cure. But the problem is the economy is so sick, we can't survive the cure. We survived it in 1980 when Reagan and Volcker force-fed that bitter-tasting medicine down the throat of the economy, and we had 20% interest rates. We were able to survive that, and we had some relative prosperity at the back end, but we can't do it now. I mean, we could in theory in the long run, but given the political realities that will intervene in the short run, there is no way it's going to happen. So what is going to happen then when the economy tips into recession? Inflation is going to get worse, not better. That genie is already out of the bottle, and just because demand is going to go down in America doesn't mean it's going to go down worldwide. And what we all should know by now, that is also a key factor in the supply and demand equation, is supply. Supply is also going to go down. In particular, domestic supply is going to go down. Now, I was reading this article about the fracking industry, and with oil prices above $90 a barrel, and a lot of these key companies are not increasing production. They're just going to enjoy a better return on their investment while they can. And the reason is they don't want to get burned again. They don't want to take the risk because they lost a lot of money last time oil prices were $90, $100 a barrel, because they did invest in more drilling, and then the price fell out and they lost a ton of money. And they're not going to risk making that mistake again. So we're not going to get this big increase in domestic supply of oil, even though the price of oil is going up. But the key point I want to make is that oil can be exported. And even if demand for oil in the US goes down as the price goes up, demand can go up outside the United States, and more US oil will end up being exported, and there'll be even less supplies available for domestic consumption because Americans compete with people all around the world. And the same thing applies to all of our imports. We're running these record imports, but if the dollar tanks, which is what will happen, because if the Fed has to do an about face, if, as I believe is going to happen, the inflation rate is still going to be high. I mean, it could be higher than it is right now, or maybe it'll be a little lower, but it'll definitely be high when the Fed pivots back to more loose instead of less loose, when the Fed has to start taking back whatever rate hikes it managed to get in, when the Fed has to go back to QE, the bottom is going to drop out of the dollar, and that's going to drive the cost of imports through the roof. But what's going to happen is, as the dollar dumps, that means other currencies are going up, and now consumers in other countries can outbid Americans for a lot of the products that were being shipped to America. So now those products aren't going to come to America. They're going to stay outside. Consumers in other countries will buy them, and that restricts the supply of goods coming into America. Meanwhile, as the dollar tanks, American goods are going to become cheaper for foreign consumers to buy, and so our exports will pick up when the dollar really tanks. So fewer goods are going to be coming in, more goods are going to be going out, so the domestic supply of goods is going to be shrinking. And even if demand is shrinking to buy those goods because Americans have less money, there's also going to be less stuff. And what matters is the relative relationship between demand and supply. So if demand goes down, but supply goes down more, price can still go up in that environment. And that is what's going to happen. That is stagflation. But the other problem is the recession itself fuels more inflationary monetary and fiscal policy. Because how does the government fight recession? Well, they do exactly what they're doing now to fight inflation, except more of it. They fight recession with expansionary monetary policy and expansionary fiscal policy. But that makes inflation worse. So if you have an inflationary recession, if you're in stagflation and you resort to the classical Keynesian remedies for recession, you are at the same time making the inflation worse. But if the recession is being caused by inflation, what you're doing to make the recession better actually makes the recession even worse by making the inflation problem worse. And that is where we're headed. In fact, look at a policy that is already being floated around regarding gasoline by the Democrats, by the president. They're talking about a gas tax holiday. And if this is passed, the federal gas tax, which amounts to 18.3 cents per gallon, will be suspended until the end of the year, which of course will take us through the election day for the midterm. So it's kind of like a bribe for the voters. Hey, the Democrats want to make your gas prices lower, so we're going to give you this gas tax holiday. And what the government is also trying to do is provide some relief from higher gas prices. Now, of course, why are gas prices high? Because the government is creating all the inflation that is driving gas prices up. Plus, you have a energy policy that is driving gas prices up. In fact, what's so hypocritical is you have all these Democrats that are talking about climate change and trying to promote alternative sources of energy. Well, the best way to promote that is higher oil prices, because if there's higher oil prices, there'll be less demand for oil, and so we'll develop alternative sources. So if you really believe this Green New Deal, you shouldn't be talking about high gas prices as if they're a problem. They're part of your solution. In fact, if we actually passed the Green New Deal, which a lot of these people claim they want, gas prices will be going up a lot more than they already have. And in fact, a lot of the Democrats who are in favor of the Green New Deal are also in favor of suspending the federal gasoline tax. But I want to get into the economics of it rather than the hypocrisy of it, because that's more important for this podcast. So the government looks at this problem of rising gas prices, and they don't understand that the reason gas prices are rising is because the value of money is falling. They're creating more dollars, and so you need more dollars to buy more gas. You need more dollars to buy more everything, and that's going to continue. So what the government wants to do, instead of getting to the root cause of the problem, they want to just try to cover up one of the symptoms, which is gas prices going up. But just like everything the government does, this will backfire and actually result in higher, not lower, gas prices.